If you're still saving money in a standard bank account, you're literally losing 5 to 6% of your wealth every single year.
It's time to stop being a consumer and start being an owner. In this video, we're giving you the exact blueprint to start investing from zero.
So no hype, no get-rich-quick schemes, just the math. Let's get started. There's a massive wealth gap in the world right now, and it isn't just about how much people are making, it's about what they do with what they earn.
Most people are stuck in the cycle of earn, tax, spend, and repeat. They're trading their time, which is finite, for money. You trade an hour of your life for a set amount of dollars. The problem is, again, that your time is finite. You only have 24 hours in a day.
So wealthy people, they don't actually trade their time for money. They trade capital for growth. They own assets that produce value while they sleep.
Today, we aren't just talking about buying stocks. We're talking about a total psychological shift. We're going to cover a 50-30-20 rule, the rule of 72, and the account hierarchy, which is the specific order in which you should invest to pay the least amount of tax.
So to make this video easy, we're going to divide this into 5 distinct phases. By the end, you won't just know about investing, you'll have a roadmap that you can actually execute to get there.
So phase 1 is the audit. You cannot invest money you don't have. You can use the 50-30-20 framework, 50% for needs, 30% for wants, and 20% for your financial future.
So if your needs go up to 80% of your income, you don't have an investing problem, you have a lifestyle problem. You have to get your fixed costs lower, you have to work on your rent, your car, your utilities before you can safely enter the market.
People often feel a moral obligation to be debt-free before they invest. They feel like any debt is a weight around their neck. But in finance, not all debt is created equal, right?
That's exactly right. So we see that so many times, and so we need to move away from that, the emotion of debt, and we need to look at the spread.
So let's define bad debt first.
So bad debt is any kind of high interest consumer liability that depreciates in value. So think credit cards, think payday loans, and this is something that we had to look up because we've never heard of payday loans before.
So a payday loan is like usually people who have like poor credit. It's easy to get. It's like a fast process. And it's usually like a $500 or less loan that kind of like gets you from paycheck to paycheck kind of. And if you had some kind of emergency bill, or sometimes people will use it to pay utilities. But the thing with those is that they do have a very high interest rate.
And then the other example is high interest car loans. And sometimes these are for people that have poor credit as well, and they just want to get the car. They don't really look at how much the interest is. So they're basically overpaying on the interest to get that particular car that they're looking for. And if you guys didn't realize this, we were also not aware of like what the credit card rates are right now.
Because we just try to pay off our credit card and then ever have to deal with.
We use credit cards, but we typically just pay them off every month. So we never really have a balance and don't pay that interest. But in 2026, believe it or not, those rates are hovering between 21 to 24% on average.
That's crazy.
Yeah.
It's astonishing.
It is.
As Buddy would say, Buddy the elf.
That's shocking.
So if you invest in the S&P 500 and get an 8% return, but you're paying 24% on a credit card, you are effectively buying a 16% loss every year. It's a mathematical hole you cannot climb out of by investing. This is actually a financial emergency.
So then on the other hand, we have good debt. And this is what we call neutral debt. In a high inflation environment, if you have a student loan that's 3.5%, or you have a mortgage that's 4%, and the stock market's historically earning 8 to 10%,
you're actually making 4 to 5% profit by not paying that debt off early.
Isn't that crazy that that people would think that way? I know that like our parents growing up were big on just putting money in their checking account. Maybe it was a savings account, but they were getting like, what was it,
Yeah, you're not even
0.002% return on that, basically like $20 a year, something like that. So it's just kind of interesting when you actually look at it this way. It's the total opposite of what you may have heard when you were growing up. So in finance, this is called arbitrage. You may be borrowing money at a lower cost than the profit you're generating from that same money. If you're aggressively paying down a 3% loan instead of investing, you're essentially buying a 3% return. That's a pretty bad use of capital when the market offers a lot more than that 3%.
So now let's talk about the emergency fund. If you watch Nishka or anybody else on YouTube, they always say it's like an investment insurance. But where do we actually keep it?
So most people make the mistake of keeping $20,000, let's say, in a standard checking account earning 0.01%, like we were talking about earlier. And that's a mistake because right now inflation is just eating that. So we recommend a tiered liquidity strategy that we're gonna walk through.
So tier 1, the immediate layer, this is a 1 month of your expenses. So this is 1 month of your expenses in your checking account. It's for the oops moments, or like you have come across a flat tire, or if you have like an emergency vet bill, or just something that's like
hot water tank explodes, which has happened to us like like in every house we've ever owned, we've had the hot water heater like explode. So
you never know.
Yeah.
Tier 2 is the safety layer. This is 2 to 3 months of expenses in a high yield savings account. In 2026, you should be looking for a rate of at least 4.5% to 5%. This is your job loss fund. It's liquid, but it's actually earning enough to keep up with your cost of living. And so tier 3 is the stability layer. This remaining 2 to 3 months can be in a slightly less liquid but higher yielding vehicle like a money market fund or a short-term bond ETF. So why do we have the tiers here? Why not just put it all in the stock market?
So that's because the market doesn't care about your emergencies. If the market drops 30%, which it does every few years, and it also has pullbacks like, 2 or 3 times a year of 10%, that's very common. And then if that just happens to be the time that you lose your job, you'd be forced to sell those stocks at the bottom.
So the emergency fund isn't meant to make you rich.
Its job is not to earn a return. Its job is to provide peace of mind. It allows you to be that long-term investor because you don't have to be a desperate seller when that bad day comes and when that drop in the market comes. Without this foundation, you aren't investing, you're gambling with your survival. Okay, now let's look at phase 2, the mathematics of time. So most people look at the 10% and they think that's a nice little gain every year, but they don't think about the exponential math behind it. So to help visualize your future, you need the rule of 72.
It's a mental shortcut. You take the number 72 and divide it by your expected annual return. The result is the number of years it takes your money to double.
Okay, so let's look at 3 common scenarios. Number 1, you have the saver at the 5% rate. So if you're keeping your money in a high yield savings account at 5%, your money doubles every 14.4 years. That's 72 divided by 5. Now you have the conservative at the 7% rate. They have a balanced portfolio of bonds and stocks that might return about 7%. Now here your money doubles every 10.3 years. That's 72 divided by 7. Next you have the aggressive. This is the 10% rate, the historical average of the S&P 500. In this scenario, your money doubles every 7.2 years, or 72 divided by 10.
It's easy to gloss over those numbers, but let's look at what that means for a $10,000 investment over a 30-year career. At 5%, your money doubles about twice. You end up with $40,000. And at 10%, your money doubles about 4 times, which you end up with $160,000.
So you didn't do any extra work, you didn't save any extra money, you just chose a vehicle with a higher velocity.
So why the number 72? Why not 70 or 75?
So it's actually a quirk of math. 72 is incredibly divisible. It can be divided by 2, 3, 4, 6, 9, and 12, which makes it perfect for mental math. However, it's the most accurate when your return is around 8%.
And if we want to look even further ahead,
that's when the expansion rules come in. If you want to know how long it takes to triple your money, use the rule of 114 instead of 72. To quadruple your money, use the rule of 144.
This is where you can see the true wealth effect. At a 10% return, your $10,000 triples to $30,000 in 11.4 years and quadruples to $40,000 in just 14.4 years.
But we have to be honest, the rule of 72 can also work against you.
This is what some people call the silent thief, inflation.
So if inflation is 3%, divide 72 by 3, in 24 years the purchasing power of your dollar was just cut in half. The $100 grocery bill today will cost you $200 in 24 years just to buy the exact same food.
And it's even scarier with debt. If you have a credit card with 24%, which means it's 72 divided by 24, that means that your debt doubles every 3 years if you aren't paying it down.
That's scary. That's a scary thought, to have your debt doubling every 3 years.
Yeah.
So this is why we say investing isn't optional. You're either riding the wave of compounding growth or you're being drowned by the wave of compounding debt and inflation on top of that.
So phase 3 is the asset deep dive. When people think of the stock market, they often think of a casino, betting on whether a price goes up or down, but that's a fundamental misunderstanding of what an asset is.
So speculation is betting on the price movement. Investing is buying future productivity. When you're buying a stock, you're buying a claim on their earnings of the company. You own a piece of every patent that they have, every piece of real estate that they own, and every dollar of profit that that company generates, you own part of that.
Let's look at the S&P 500 specifically in this instance. It's the most discussed index in the world for a reason.
In 2026, the S&P 500 represents about 80% of the total value of the US stock market. 80% of the total value of the US stock market. It's essentially a winner-takes-all type of system.
This is what a lot of people call the self-cleansing mechanism.
So just think about 20 years ago. Companies like Sears or General Electric dominated the index. I've seen a video on this, and it's amazing to think about that. And I bet in that moment, those people, you know, we couldn't have imagined that there would be a new leader or these new companies that came out of nowhere. You know, people back in the day thought Sears and General Electric were the big deal. And then I think GE, like their stock has been crashing for a long time. I haven't looked at it lately, but it's just gone nowhere. And then Sears is like
non-existent.
Yeah, it used to be in every mall. You guys have, and what's a mall? Because people, you know, we barely go to a mall anymore either.
I know, and now you have the giants of Amazon. Who would have ever thought Amazon, who started off as like we bought books from Amazon?
Yeah,
that was
and then you got Facebook.
Yeah.
Like who would have thought that Facebook would become, now it's Meta, but you know, it's just
It started out as like college kids. You had to have a college email to be able to access it, and now like as long as you have an email, you can access it. It's
that's really all it was.
Yeah.
So anyway, as they became less efficient, those companies, they were automatically fired from the index and replaced by top companies like Nvidia and Tesla.
So as an investor, you don't have to spend your weekends reading balance sheets. The index does the hiring and the firing for you. You are simply betting on the collective ingenuity of the 500 most successful corporations in the world. But 100% stocks can be a crazy, wild ride. That's where bonds can come in.
If stocks are the engine, the bonds are the suspension of the car. A bond is a debt instrument. So if you're a bank and you're lending money to the government or a corporation, in return they pay you a fixed interest rate, and that's called a coupon.
In 2026, with interest rates stabilizing, bonds are back to being a critical part of a balanced portfolio. They don't provide massive growth, but they provide non-correlated returns.
And that's a fancy way of saying when the stocks go down, bonds often stay steady or they go up. This prevents you from panicking when your portfolio drops.
This is where most beginners get fleeced. They understand what to buy, but they buy it in the wrong vehicle.
You'll probably hear the bank talk about mutual funds, and these are actively managed. So somebody that's in a suit is trying to pick the winners. For this, they charge an expense ratio, and that's something like 1 to 1.5%.
But an ETF or an exchange-traded fund is passive. It just tracks the index automatically. Because there's no manager to pay, the fee drops to near zero.
Okay, so looking at this visual, go down to the bottom line. On a $500,000 portfolio, that 1.25% isn't just a small charge. It's the cost of a home or years of early retirement.
The math is clear. In 2026, the most efficient way to build wealth is through low-cost, broad market ETFs. You want the lowest expense ratio possible so that the compounding works for you, not the bank.
Okay, let's go to phase 4, the account hierarchy. Before you look at anything else, you have to look at your employer's retirement plan. Now, if you're in the US, you have a 401k, and if you're in the UK, you have a workplace pension. But most of these companies in either case offer a match.
This is the only place in the world where you can get a guaranteed 100% return on your money. If you put in $100 and your boss puts in $100, you've doubled your money before it even touches the stock market. But a more common formula for this is a 50% match on the first 6% of your salary, or a 100% match on the first 3 to 4% of your salary. So you definitely have to just pay attention to it, but don't not take advantage of it. That's the whole point.
Yeah, I know if you guys have watched some of our previous videos, I know it's not a 100% match, like a 1-to-1, 100% match like I've gotten in the past. Granted, I had a very low salary at the time when I was just starting off, but still. Okay, so you never want to skip that. If you don't contribute enough to get the full match, you're actually taking a voluntary pay cut.
So the point is, take it. Like, it is free money, essentially. Take it no matter what the percentage is.
And it's actually amazing. In the last 20 years that I've spent working a 9-to-5 in corporate America, it's amazing how many people I've come across that do not max that out. Even if it's only up to the 6% of your salary, it's shocking to me how many people say they can't afford to do that. And I think the typical response should be, you can't afford not to do that.
Yeah. And then if you put it in through your paycheck, you'll never see it and you'll never miss it. That's the whole point. Like,
Yeah.
Don't let it come to you so you feel like you're missing something. Go ahead and take it out and then deal with all the other things in your budget after that. So
I know. I even had a previous CEO of a company that I worked for. He said that you should actually potentially take out a loan. If you can't afford that, you should take out a loan at a lower interest rate so that you can max out your 401k and get that 100% match up to the 6% of your salary or whatever it is that they offer. Isn't that kind of crazy to think about? That you'd be better off actually getting a loan to pay your bills so that you can max out your 401k.
So once you've secured that match, the next dollar should go into what we call a tax-free wrapper. This is an account where you pay tax today, but you never pay tax again.
So for US viewers, in 2026, the Roth IRA limit increased to $7,500 or $8,600 if you're over 50. The beauty of the Roth is that your contributions can be withdrawn at any time, and if you're in a pinch, though we don't recommend it, but the growth, that stays tax-free forever.
For our UK viewers, the Stocks and Shares ISA remains your powerhouse. You can shield up to 20,000 euros per year. No capital gains tax, no dividend tax. If that 20,000 euros grows to 1 million euros over 30 years, you keep every single penny.
So if you still have money left over after contributing to the Roth or ISA, you go back to your workplace plan and you try hitting that ceiling.
In 2026, the 401k employee limit is now $24,500.
So you might be asking, why would you wait to step 3 to do this? And that's because your workplace plans often have limited investment choices and higher fees than an IRA that you could open yourself. By following this order, you ensure that you get your free money first, the best tax-free growth second, and the high-volume tax-deferred third.
Finally, we have the standard brokerage account. This is where you go when you've beaten the game for the year and maxed out all your tax-advantaged buckets.
So in this scenario, there's no limits. You can invest $1 million today if you have it. The downside is that you'll pay taxes on your dividends every year and you'll pay capital gains taxes when you sell.
However, the benefit is flexibility. Retirement accounts have age restrictions like 59.5 in the US or 57.58 in the UK. A taxable account is your early retirement fund. It's the money you can access at age 40 or 45 without a penalty.
To show you why this hierarchy matters, if you invest $1,000 a month in a taxable account, you might lose 1 to 2% of your return every year due to tax drag.
Over 30 years, that small tax bill compounds. You could end up with $300,000 less than if you had simply followed the hierarchy and used a Roth or an ISA.
You aren't working harder, you're just being more efficient with the government rules.
So now we're on to phase 5, the execution and the automation protocol. The biggest reason people never make their first trade is platform paralysis. They spend 3 weeks researching which app has the prettiest interface and 0 minutes actually investing.
In 2026, the playing field is very level. If you want a one-stop shop where you can have your checking account, your credit card, and your investments all in the same place, Fidelity is currently the industry leader in the user experience.
So if you're a minimalist who just wants to buy the index and never look at a chart, Vanguard's app redesign has made it incredibly simple. For us, we use Fifth Third Bank for our checking account. We use Interactive Brokers for our brokerage account, Charles Schwab for our IRAs, and Citibank and Chase for our credit cards.
So we pretty much use everything. And I think over the years, we've used so many different companies and tried them out. And we just kind of like I think we like the size of Charles Schwab. We know that they have the largest assets under management. So we wanted to go with that. And then we like the Interactive Brokers. It has the cheapest portfolio margin account rates. So the cheapest margin rates, which we'll talk about that in another video. We don't use that very often, but we do like having that as sort of a backup plan if opportunities present themselves. Mm-hmm. So that's a little bit of background on what we use. There's probably better combinations of things, but that's just kind of what we've sort of gotten used to. Mm-hmm. So the key here is to pick one today. Don't look for the perfect one because that doesn't exist. Look for the one that feels right and is easy to navigate and it doesn't overwhelm you. Most of these have a $0 account minimums, which is really nice. Things have changed a lot in the last 5 to 10 years. But this means that you can start with like literally the change in your pocket. You don't have to have like $5, $10, $15,000 to open an account these days.
So I remember when you needed like 500 just to buy one single share of a big tech company, and Jared and I were just talking, like, I feel like in high school when you did the paper shares, it was like you had to have, this big chunk of change to buy Apple or any of these bigger companies, and like if you didn't have it, then you couldn't buy it. So that used to be a really huge barrier for beginners.
I know. I've even had, I can think about a few people that have said, well, I'm not going to buy Amazon because those shares, well, that was actually before the stock split, but when that was like $1,000 a share, people would say, well, I'm not going to buy that because it costs too much. And then I would say, no, there's fractional shares, so don't think that way. So you guys don't not buy stock in a particular company because their shares are too high. But look at how much one share of Berkshire Hathaway Class A shares cost.
Who's buying that?
But luckily they have Class B shares, which we buy. But that's pretty crazy that one share costs that much.
So let's explain the math on these fractional shares.
So if one share of the S&P 500 ETF costs $500, but you only have 50, you don't have to wait. You can buy a tenth of a share. Okay, and this is vital because it allows you to stay 100% invested. You don't have idle cash just sitting around in your account waiting until you can afford a full share of Berkshire Hathaway Class A shares. Because you might be waiting a while if you're gonna do that. So anyway, every dollar that you transfer goes to work immediately and it's invested in something.
So that's the nice part. Like you were saying, like you will have to wait forever to buy this Class A share, but like you're waiting forever, but you're not getting the gains that you potentially could get if you would buy that fractional share. Put $10 in or whatever you can into that and let it grow, because it will still grow the same amount. You just don't have, $50,000. You just have $100 in it.
And that's really cool for new investors and particularly our kids. We're working on opening up accounts for them through Interactive Brokers. So they're each going to have their own account, and then the money that they earn through, we'll have to do a video on that, but we have a pretty cool system.
Allowances, birthdays. Any money that when they sell something.
Yeah, they're starting to accumulate some pretty good money. And we want to let them invest in some index funds and stocks, and fractional shares is going to make that possible. Otherwise, they'd have a tough time. So we're looking forward to getting that opened up for them and then getting them on board with that, with investing.
Yeah. So this is the secret sauce. How do we make this so that we never have to think about it again?
The way to do that is you set up a recurring transfer. So you sync your bank account to your brokerage, and each of the banks, they have a little bit of a different method on how to do this, but it's definitely something that you should check out and that you should do. So you sync your bank account with your brokerage in whatever fashion they have available. You set up a transfer the day after you get paid so that comes out automatically and you don't have time to change your mind or buy something else. So if you get paid on the 1st, for example, have this set up so that your money comes out on the 2nd. Set a recurring buy order. Apps let you do this specifically now. So every month, for example, on the 3rd, you can buy $200 of VOO. That's one of the index funds for the S&P 500, for example. And you can set that up to be, whatever ETF or ETFs you want, or individual companies.
And don't forget the DRIP, which is the Dividend Reinvestment Plan. When you open your account, there's a tiny checkbox that asks if you want to reinvest dividends. You should check it. This ensures that every time the companies you own pay you a profit, that money is automatically used to buy more shares. This is compounding on steroids. And for us, we don't actually do this. We don't actually use this. Okay, so we set it up once and then we're done forever.
Not quite. A lot of people probably do that, but you should really do like a 6-month review, a biannual audit, whatever you want to call it. So every 6 months, check 2 things at least. One is your surplus. So if you get a raise, increase your monthly auto invest by 50% of that raise. And that also helps you with avoiding lifestyle creep, which is a big thing. The next thing is rebalancing. Ensure your ratio of stocks and bonds hasn't drifted too far.
But other than that, your job is to go live your life. The system is built. You are now an owner of the global economy.
So the market will go up, it'll go down, and your only job is to really not touch that stop button at any point. And that includes when the stock market, it especially includes when the stock market is dropping. Definitely don't stop contributing then.
So we've given you the full blueprint from the first dollar of debt to the final automated trade.
So success in investing isn't about being the smartest person in the room. It's about being the most disciplined person in the room.
Start today, even if it's just $10. Don't let this be just another video you watch. Let this be the day you started.
So thank you guys so much for watching. Please like, subscribe, and continue to watch our videos. And we'll see you in the next masterclass like this one.
Yeah. Bye, guys.
Bye, guys.